Anil, do you know how entrepreneurship can create a huge impact in a nation?
No. Divya ma'am, how can entrepreneurship ever can make any impact on a nation?
Let me tell you how. First of all, entrepreneurship can create goods and services on both national and local scale. Entrepreneurship creates jobs everywhere. For this reason, the contribution of entrepreneurship just cannot be measured in purely monetary terms. Entrepreneurship creates a product or service of notable worth, while at the same time it builds a substantial customer base. The benefits of entrepreneurship actually span economy and society, leading both to prosperity. Entrepreneurship also helps the local economy. The success of entrepreneurship in the local market creates a vibrant economy. This itself creates wealth as well as jobs for the local population. For the nation, entrepreneurship helps the national economy scale for the government, which is taxation. Entrepreneurship can create a product or service that adds value to the lives of its users. Innovation at the base level of business can push a market forwards on domestic and overseas. This can only be done by vibrant entrepreneurship. So, one can say that entrepreneurship is a key driver of economic growth. Many industries and economy are at ale at times. So, by risk-taking entrepreneurship, it can rejuvenate ailing industries and economy. It can also spur governments to create an effective economic and legal framework.
Divya ma'am, how do we recognize or create an opportunity?
It depends upon how valuable is the opportunity. The questions that arise after the opportunity is identified are how do we know it's valuable and valuable for what? And how do we exploit it and where? It could either be exploited in an industry or market segment. After that comes the question of when. That is, can the idea be exploited in a market's evolution? And how? It means what exactly to produce and how to charge. Next comes the tactics. What type of tactics has to be applied in financing, exits and growth rate and appropriating rents? With what effect? Opportunity discovery needs some luck too. The odds can be managed once it is discovered. We need to remember to be prepared for the opportunity. Just luck will not be enough to achieve success. Also, once an opportunity is discovered, then you need to know what to do with it.
Divya ma'am, I have heard that markets grow at different rates. Is it true?
Yes, Anil. All types of markets grow at different rates. The idea is to identify a market that is structured and stable, but is still growing and it does not require a very large capital outlay. The graph shows the market size and how it grows along with time span. Markets can be divided as large market size and growing market. You need to identify a market niche that provides high value to customers so that to achieve success as an entrepreneur. Customers are reachable and can be addressed. There are no major brand loyalties if you know how to reach out to your customers. The payback to the customers can be identified and is repeatable. The benefit to the customer in monetary terms exceeds or at least covers your costs plus a reasonable profit. Potential for product expansion and being a market leader. Industry should neither be highly concentrated or highly competitive. After identifying the market potential, you need to concentrate on economics.
Economics. How can this factor play a role in entrepreneurship, ma'am?
Let me explain that to you. Economics flows with time. You need to check the time for positive cash flow. Cash flows, simply put, is the difference between the cash that flows in and cash that flows out. Upfront, the capital needs to be low. Research and development requirement, both initial and ongoing, needs to be low. High gross margins is the difference between the selling price and the cost of manufacture. The personal harvest is what is in it for you. The venture should be high strategic value to a potential acquirer. Pharmaceutical firms acquire entrepreneurial firms for more than what it is worth because it is of strategic value for them. Many times, technology startups that have accumulated losses and modest sales get acquired for many times their worth. Strategic value comes from having important customers, distribution, or a proprietary technology that has strategic value to an incumbent in an industry. Does it cover your opportunity costs? The money that you will make from your personal next best option plus other non-monetary things that you will be giving up. Competing with incumbents is called competitive advantage. The questions that arise here are: can you compete with existing players if they enter? Can you produce at low costs? Can you achieve economies of scale? What are the entry barriers for your competitors? When you can calculate all these, you will become a successful entrepreneur.
That was really very informative, Divya ma'am. I will note these down. Thanks.
You are always welcome, Anil. Anil, do you know cost affects the business?
Cost? What kind of cost, Divya ma'am?
Cost is the monetary value of resources like material, labor, and overheads used in the making of a product or delivery of a service. In many cases, there may be no material involved in the delivery of a service. So, the involvement of cost in business varies by the nature of the business. Cost can be classified in various ways. Here are some of the ways. Some costs are based on association with cost object. It is also called direct versus indirect costs. Some costs are based on reaction to changes in activity. It is also called fixed versus variable costs. Some costs are based on classification on financial statements. It is also called expired versus unexpired costs.
Ma'am, can you explain how each of these costs work in business activities?
Sure. Let me explain them to you one by one. Direct versus indirect costs are based on their association with different cost objects. A cost object is an item or object for which costs are measured separately. Here are some common types of cost objects. Output is the most common way of defining cost objects. It is based on a business's output because a business would want to know the cost of producing or creating its output. Operational is based on department within the business or a specific operation or process. For example, a business could measure the cost of a customer service call. Business relationship is based on an entity outside the business. For example, cost could be aggregated for each supplier or customer. Direct costs are those that can directly and easily be traced to a cost object or objects. Indirect costs are those that cannot be economically traced to a cost object and hence these costs must be allocated to a cost object or objects.
Earlier, We had discussed about the business of Raju, the Thela Wala. How does cost object works in his case, ma'am?
Yes, cost object may work in many ways when it comes to Raju the Thela Wala. Cost object for Raju the Thela Wala could be seasonal vegetables and non-seasonal vegetables, or green vegetables like beans or lady's fingers, root vegetables like potatoes or carrots, and other types of vegetables. If he starts selling fruits also, cost objects could be vegetables and fruits. The cost of fruits and vegetables are direct costs because they can be traced to the two cost objects, fruits and vegetables, respectively. Let's say that Raju the Thela Wala buys tea during winter and Nimbu Pani during summer while working at his thela. The costs of tea and Nimbu Pani are indirect costs because their costs cannot be traced back to the two cost objects, fruits and vegetables. So, the costs of tea and Nimbu Pani must be allocated to the two cost objects.
There are also fixed versus variable costs. How does it works, ma'am?
Let me tell you how. To understand how costs change with output, it is useful to classify costs as fixed and variable costs. Costs that do not vary in the short term regardless of changes in output levels are called fixed costs. Costs that vary with the output levels are called variable costs. For Raju the Thela Wala, the cost of his thela is fixed because it does not depend on how much fruits and vegetables he sells. The cost of fruits and vegetables sold is variable because it varies with how much fruits and vegetables he sells.
What about expired versus unexpired costs? How does it works in business, ma'am?
Expired versus unexpired costs calculation helps to check how the capital is being used. To determine if a cost should appear on the balance sheet or income statement, it is useful to think of costs as expired and unexpired costs. Expired costs are those that have been completely consumed or the benefits from which have been received by the business. Unexpired costs are those that have not been consumed fully as yet and have some residual value. If you look at the P&L statement, you will notice that all expenses are represented as expired costs, whereas assets on the balance sheet represents unexpired costs. In the case of Raju the Thela Wala, the cost of fruits and vegetables sold are expired costs, as they will show up as cost of goods sold, simply called COGS on the P&L statement. The cost of fruits and vegetables not sold as yet are unexpired costs, as they will show up under inventory on the balance sheet. The annual depreciation cost of his thela will be expired cost and hence recorded on the P&L statement. The value of his thela net of depreciation cost will be the unexpired cost and hence recorded on the balance sheet. This unexpired cost of the thela will reduce by the annual depreciation cost every year on the balance sheet. If we assume a 10-year useful for the thela and an initial cost of rupees 10,000, its unexpired cost will be rupees 9,000 after 1 year, rupees 8,000 after 2 years, and its unexpired cost will be 0 after 10 years.
Ma'am, does all inputs in a business can be converted to sellable outputs?
Yes, of course. Let me elaborate the degrees of conversion to you. Almost all businesses convert or modify inputs to a sellable output. Inputs typically consist of raw material, labor, and overheads. The cost of conversion is dependent on the degree of conversion done by a business. You could think of 3 degrees of conversion: low, moderate, and high. Providing convenience to customers in terms of location, timing, and variety with almost no physical conversion of inputs is termed as a low degree of conversion. In the example of Raju the Thelawala, he provides ease of access in terms of location and timing to fruits and vegetables for his customers. Some amount of visible conversion to the output is termed as moderate degree of conversion. For example, Raju the Thelawala removes unnecessary leaves, roots and stalks, washes and packs the fruits and vegetables in plastic before selling them to his customers. A major transformation from input to output is termed as high degree of conversion. An example of this would be a two-wheeler company like Bajaj Motors or Hero MotoCorp. They take inputs consisting of various parts of a two-wheeler made out of metal, plastic and glass and convert it to two-wheelers motor vehicles. Retail companies like Reliance Fresh, D-Mart, Big Bazaar have low to moderate degree of conversion. Manufacturing companies like Bajaj Auto, Hero MotoCorp, Amul, Asian Paints or Bombay Dyeing Textiles have a high degree of conversion. Product costs are the key determinants of the cost of goods sold or COGS, which appears on the P&L statement. They represent the cost of items or services used to generate revenues. The 3 main components are direct material, direct labor, and overheads. Let's discuss about each of these factors. It is the cost of any material directly used in the production of the output. For example, for a two-wheeler, it would include the costs of engine, fuel tank, shock absorbers, mirrors, handlebar, wheels, or tires. Direct material costs are significant for manufacturing companies like Hero MotoCorp, Amul, or Asian Paints. Direct material costs are low or insignificant for service companies like Infosys, Wipro, State Bank of India, or ICICI Bank. Direct labor costs refer to the cost of individuals involved in manufacturing a product or delivering a service. The cost includes salaries, bonuses, insurance, pension benefits, earned leave paid to the individuals involved. It typically does not include overtime costs paid to the individuals. It does not include salaries of executive, salespersons, commissions paid to the sales team, advertising, utilities paid for the administrative building or any other structures constructed for business purpose. These are not directly involved in the manufacturing of a product or delivery of a service. While direct material cost and direct labor costs are direct costs, overheads costs include indirect costs incurred in the manufacturing of a product or delivery of a service. For example, in the manufacture of a two-wheeler, it will be very difficult to keep track of the exact amount and cost of glue and exact number or cost of screws used. The cost of glue and screws will be indirect costs. But the cost of these must still be included under product costs. To know how these costs are calculated, we need to know about cost allocation. As we have already discussed that indirect costs like overheads cannot be easily traced back to a product or service. Hence, businesses need to allocate these costs to each product or service or broadly each cost object. Cost allocation is a method through which a business allocates or distributes an indirect cost across various cost objects. There are 4 parts to cost allocation: cost pool, cost objects, cost driver, and allocation volume. Let's discuss about each of them. Cost pool. This is the total indirect cost that needs to be allocated across cost objects. Cost objects, as we already know, is divided into direct and indirect cost. Cost driver is defined as some attribute or characteristics that we can measure for each cost object. Allocation volume is the aggregate of the cost driver amounts across all cost objects. The steps in cost allocation are determined by overhead rates. The overhead rate is the amount in the cost pool divided by the allocation volume. To know the allocation of cost, multiply the overhead rate by the number of cost driver units in each cost object.
Ma'am, can you explain how the cost allocation works in the case of Raju the Thelawala?
Sure, Anil. Let's see how cost allocation works in this case. In the case of Raju the Thelawala, tea and nimbu pani are indirect costs that he incurs. Now, how does he allocate the costs of tea and nimbu pani to the cost of fruits and vegetables sold? To know exactly that, we need to identify the 4 parts of cost allocation. First would be the cost pool. Let's say that he spends a total of ₹20 on a given day to tea or nimbu pani. Next are the cost objects. Raju has 2 cost objects, fruits and vegetables. After that comes the cost driver. Raju takes the total kilograms of cost object sold as his cost driver. Cost drivers are the number of kilograms of fruits and vegetables sold. At the end, we need to know his allocation volume. The allocation volume is the total kilograms of fruits and vegetables sold. Let's say that he sold 10 kilograms of fruits and 15 kilograms of vegetables. So, allocation volume is 25 kilograms. The overhead rate is the amount in the cost pool divided by the allocation volume. 20 divided by 25, which is rupees 0.80 per kg. Cost allocated to each cost object. Fruits, 0.80 multiplied by 10, which is equal to rupees 8. Vegetables, 0.80 multiplied by 15, which is equal to rupees 12. So, the rupees 20 indirect cost has been allocated as rupees 8 to fruits and rupees 12 to vegetables cost objects.
That was very knowledgeable, Divya ma'am. Thanks for all these information.
As always, you are most welcome, Anil. Anil, do you know what long-term orientation is?
No. Divya ma'am, what is a long-term orientation?
A long-term orientation is adaptation to knowledge learned while being an entrepreneur. Over the years, you will learn so many new things that you will learn how to adapt to new things. Discovering an opportunity is a combination of personal characters and knowledge learned. Individual traits that matter in entrepreneurship is what we call stable characteristics. Some personal preferences to be entrepreneurs are risk-bearing and tolerance for ambiguity. A lot depends on ability to evaluate new information, for combining what you know with new information to see means-ends relationship, which can be like, see how to fix what's broken or improve on what's out there. Anil, you should know that a subjective process is built on a person's particular capabilities.
What kind of capabilities, ma'am?
Along with a person's particular capabilities, it is a subjective process that builds on what a person knows or the knowledge that he or she can absorb. This subjective process grows stronger with time and experience. Substantively, like molecular biology, a particular market can be built over a person's particular capability. Procedurally, you will have to adapt to management with new interpersonal skills. What help here are whom you know, what are the weak ties, and what sort of creativity you have achieved so far.
Divya ma'am, I have also heard about transactions in business. Do you have any idea about this subject?
Sure, there is also a factor called recording business transactions. Without business transactions records, it will be very difficult whether the business is in profit or loss.
Can you tell me more about how the transactions are done in business?
Sure, for that, you will have to first know about the 3 financial statements used to record business transaction.
What are they?
The 3 financial statements are used to record and report a business transactions are balance sheet, profit and loss statement, P&L, and statement of cash flows. Let's first learn what a balance sheet is. A balance sheet is a record of all of a business's existing assets, liabilities, and equity. It measures the uses of capital. Capital must equal sources of capital. From that, we can derive that total assets is equal to total liabilities plus equity. A balance sheet changes all during the year as a business repays capital, raises new capital, acquires new assets, and sells old assets. However, at all times, total assets must equal total liabilities plus equity. Equity and liabilities come first in a balance sheet, followed by assets.
Divya ma'am, can you provide me with a simple example so that I can understand better about balance sheets?
Sure, Anil. To understand the concept better, let's look at a simple example. Let's say that a person Raju has 20,000 rupees and wants to buy a thela to sell vegetables. The 20,000 rupees is his equity in the business. He has provided 20,000 rupees of his own money for his business, which will be recorded on the asset side of the balance sheet. The balance sheet will show that the equity of Raju is 20,000 rupees, as he has the asset of 20,000 rupees. His liabilities is 0. Now, let's say that he pays 10,000 rupees in cash to buy his thela. The balance sheet will now show that his equity is 20,000 rupees, while his cash asset is 10,000 rupees, as he paid that amount to buy the thela. His liabilities still remain 0. The purchase of the thela is now recorded on balance sheet. From the table, you can note that the left-hand side of the balance sheet has not changed because Raju has not provided any additional capital to his thela business. A balance sheet is incomplete without a P&L statement.
What is a P&L statement, ma'am?
Well, let's look at what P&L statement is. P&L statement is a record of all of a business's revenues and costs over a certain period of time. Most often, it is calculated every quarter or every year. A business's profit is defined as the difference between its revenues and all its costs. Continuing with the same Raju Thelawala example, let's say that Raju spends rupees 2,000 to buy vegetables. This is his cost. For now, let's not worry how this will impact his balance sheet. He then decides to sell his vegetables for a total of rupees 3,000. This is his revenue or sales. His P&L statement is now can be shown as rupees 3,000 as the total revenue, while the cost of purchasing the vegetables is rupees 2,000. His profit is revenue minus cost, which is rupees 1,000. Actually, the P&L statement records all transactions on an accrual versus cash basis.
Accrual versus basis?
Let me explain what accrual versus cash basis is. In the case of Raju, the thelawala vegetable vendor, let's say that his customers will pay him the rupees 3,000 only at the end of the week. On an accrual basis, the rupees 3,000 will be recorded as revenue on the day he sells the vegetables to the customers, regardless of if and when the customer pays him. Similarly, if he has not paid the rupees 2,000 to the person who supplied him the vegetables today, he will still have to record it as a cost on the P&L statement today itself, even though he may take 7 to 8 days to pay his vegetable suppliers. This is accrual versus cash basis business. So without the calculation in accrual versus cash basis, if transactions were recorded on cash basis on the P&L statement, in this situation, he will have 0 revenues, 0 costs and 0 profits because his customers have not paid him and he has not paid his supplier. To better understand such a situation, we need to know the statement of cash flows.
So, we also have to keep a tab on the factor of cash flows, ma'am?
Exactly. Without the statement of cash flows, it will be difficult to know how the business is functioning monetary-wise. Given that the P&L statement records transactions on an accrual basis, it is difficult to use it to understand how much cash a business has on hand at any point of time, especially for the large businesses having many transactions. The P&L statement also excludes any asset purchases or sales, as well as any capital raised or repaid. A business cannot survive for long without cash. The statement of cash flows fills this gap. Cash flows keep track of cash-related revenues, costs, investments, and financing, and report the additional cash generated or used by a business every period.
So, ultimately we can see that cash is king.
Definitely. Let's learn more about statement of cash flows.
Does cash flows also consist of many parts, Divya ma'am?
Yes, it does. Cash flows consist of 3 parts. Cash flows from operating activities, cash flows from financial activities, and cash flows from investing activities. Let's look at each of them to check how they work. The first is cash flows from operating activities. Operating activities include all activities related to the purchase and processing of raw materials and selling of a business's products and services. The second is cash flows from financing activities. Financing activities include capital raised through debt and equity, as well as loans repaid and dividend paid. The third is cash flows from investing activities. Investing activities include purchase and sale of long-term assets like plant, machinery, computers, furniture, as well as shares of other businesses.
Would not it be very difficult to know how the cash is flowing in a bigger business situation, ma'am?
Definitely. For that, there is a system called recording of transaction. Let's try to understand how this concept works. A large business may have hundreds, thousands, or even lakhs of transactions each day. So, it is difficult for it to keep track of the large number of transactions and constantly updating the balance sheet, P&L statement, and statement of cash flows after each transaction. Missing out even a single transaction could have serious consequences for the business. Accountants worldwide use the double entry system to record transactions.
Double entry system? What is it, ma'am?
Transactions are entered into the general journal in the chronological order, including which accounts each transaction affects. Every transaction in the general journal has two entries, a debit and a credit. For this reason, it is called double entry system, which impact at least two ledger accounts. Debits are entered on the left-hand side and credits on the right-hand side. The total on the debit side must equal the total on the credit side for every transaction.
Does that mean that the general journal looks very complicated, ma'am?
Well, no. If you look at the general journal in a simple way, it is not very complicated. This is how the general journal looks. The first entry is the date. It is the date of the transaction. Then we need to enter the particulars. Each transaction affects at least two accounts. The names of the accounts are entered here as well as a brief explanation of the transaction. Include a DR at the end of the line of the account being debited. And start the line of the account being credited with a TO. Then enter the ledger folio. Entries from the journal are posted to ledger accounts. This column records the page number of the ledger account into which the entry is made. It is either debit or credit. The debit is the amount being debited from at least one ledger account. The credit is the amount being credited to at least one ledger account. A ledger account lists all increases and decreases of a particular account. Examples of ledger accounts are cash account, debt account, inventory account. Ledger accounts can broadly be classified into personal accounts, real accounts, cash accounts, and nominal accounts. Personal accounts are accounts that relates to persons like capital account, salary account, bank account. Real accounts are accounts that consist of properties of the business like cash account, stock account, patents account. Nominal accounts are accounts that consist of expenses, losses, incomes, and profits. The general ledger is a collection of all ledger accounts. Now, the rule of the thumb is how to determine if something is a debit or credit.
Well, how is it done, ma'am?
The rule of thumb relies upon the personal accounts, real accounts, and nominal accounts to check the debit or credit. In the personal accounts, the debit is the receiver and the credit is the giver. In the real accounts, the debit is what comes in and credit is what goes out. In the nominal accounts, debit is all losses and expenses and credit is all profits and incomes. Now again, if you look at the example of Raju, the thelawala, and how he started his business, you will understand better. Raju increased equity capital from ₹0 to ₹2,000 and at the same time increased cash from ₹0 to ₹2,000. Cash is a real account because it is owned by the business and it is coming into the business. Also keep in mind that debit is what comes in. Raju's contribution is capital he gives to his business and hence is a personal account that needs to be credited. Again, remember, credit is the giver. So, this transaction will be entered in the general journal, assuming that it is done on 1st January 2019. On 3rd January 2019, he spent rupees 2000 to buy vegetables and sold them for rupees 3000. Cash is still a real account. The purchase of vegetables will be credited for rupees 2000. The credit is what goes out. At the same time, the sale will be debited for rupees 3000. Purchase and sales accounts are nominal accounts. Here, the credit is all profits and incomes, and debit is all losses and expenses. These transactions will be entered in the general ledger as shown on the screen. It first starts with the date, then particulars, then debit, and at last the credit, as we have already discussed. His cash account in the general ledger will look as shown on the screen. Here, the particulars and the amounts are highlighted. You can also notice that it starts with the DR and the end with the CR. This is about debit and credit. Raju's capital account in the general ledger will look as shown on the screen. The Thela account will look as shown on the screen. The purchase account will be as shown on the screen. As he had purchased vegetables for rupees 2000, it is entered to the cash account row. Raju's sales account will be as shown on the screen. As he had sold the vegetables for rupees 3000, it is entered under the particulars column along with the amount. Now, can you understand how the entries are made into the ledger, Anil?
Now I understand how business transactions are recorded. Thank you, Divya ma'am.
You are most welcome, Anil.